market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Oil prices this morning continue to climb as prospects for an end to the war in Iran fade, with President Trump ruling out extending the truce with Tehran. Trump has also insisted that the US controls the Strait of Hormuz through its naval blockade and again floated the idea of declaring the waterway American territory.
I just think it's a great idea. Yeah, I mean, we control it. We control it with the blockade. We have a blockade. We control it with the blockade. And I like the idea of declaring it a territory.
So where do we go from here? Let's speak now to Bloomberg's Abir Abu Omar in Dubai. Abir, the truce has expired between the US and Iran. Both sides are talking about control of the strait. Where do we go next?
Good morning, Lizzie. Well, that truce that was reached in June back in Switzerland to end the fighting for 60 days was essentially rendered meaningless by Iran. President Trump also saying that he will not plan on extending it. But essentially, so many violations have occurred over the past 60 days or so that, again, from the perspective of Iranian officials, that MOU really means nothing. They have not discussed any of the concessions that were part of that ceasefire agreement, namely that nuclear component that is still pretty much President Trump's main goal in all of this. But then the side conversations that are happening are between Iran and Oman. We've been reporting on those, of course, for the good part of the past 2 weeks. And we've been saying that according to both sides, those negotiations to find a mechanism, to find a pathway in the Strait of Hormuz to get a trickle of oil really are in the final stages. The last we know is that those continue to be in the final stages. But perhaps what oil markets are reacting to are some of the hostilities, Lizzie, that we've been seeing in the early hours of the morning. The UK Navy did report that an unidentified projectile had hit a vessel, that a casualty had occurred there. And just moments ago, our energy teams reporting that a fuel tanker trying to enter the Persian Gulf has made an erratic series of turns and finally stopped next to the Kushner Island in Iran, really showing that Iran is still very much trying to assert dominance over the Strait of Hormuz. Meanwhile, of course, the United States maintains its naval blockade in the strait, and so you've got a situation where oil is not moving. Still, according to the United States, some oil barrels are moving from their side, but nowhere near where it was pre-war. So you've got that situation, the Strait of Hormuz, and of course, a lot of parallel fighting that is happening in the wider Middle East. That includes in Saudi Arabia, the Red Sea, Gaza, Hamas. That is flaring up yet again.
Well, let's turn to Gaza now, because also President Trump's son-in-law and peace envoy, Jared Kushner, has been meeting with Netanyahu, the Israeli Prime Minister, as well as Hamas leaders. So Abir, what other progress are we seeing when it comes to acceleration towards a Gaza ceasefire? Is there possibility of meaningful progress at all?
Yeah, that's a good question, Lizzie. And we've been talking to a lot of analysts when it comes to this. So what we know is that Jared Kushner had met with Hamas leaders in Egypt before going to Israel and meeting with Netanyahu. Look, it's a situation of who blinks first at the moment. So Israel refuses to leave Gaza before Hamas disarms. And then you've got the Hamas situation where Hamas says that it won't disarm before Israeli troops withdraw. So it's really a situation of waiting and seeing what exactly will happen there. But just bear in mind that this is all happening at a time where elections in Israel are looming, and a lot of this conversation will be happening ahead of that election where the destiny of Prime Minister Netanyahu will be determined. And so we're waiting to see if there is any progress on that wider board of peace plan that President Trump had touted yesterday. He was saying to Fox News that he will endorse someone in the Israeli election. So a lot of unclarity about what exactly that means and if he will indeed endorse Prime Minister Netanyahu. We reported multiple times over the past 6 weeks that within the wider parameters of the war with Iran, of which, of course, Israel had taken part in the initial strikes, there were some tensions in that relationship between the United States and Israel, between President Trump and Prime Minister Netanyahu. So a lot of factors to the broader puzzle, if you were here. Another wait-and-see situation in the wider conflict in the Middle East, Lizzie. OK, Abir, thank you for the update. That's Bloomberg's Abir Abu Omar.
Well, all of that isn't helping your bond space this morning. The misery going around the world. European bonds following the US and Asia lower after 30-year Treasury yields climbed to levels not seen since 2007. As I say, that's partly driven by elevated energy prices. It's also driven by concerns over government finances. And Yardeni Research has even warned of investor unease over the debt levels, saying that it's closely watching whether the bond vigilantes might hit the panic button. They haven't yet, but let's bring in Ven Ram, cross-asset strategist over at Bloomberg MLive. Ven, why now is this happening? These concerns have been around for a while. Is it the lack of other catalysts in markets, or how big of a role is the AI story playing here? We've got Alphabet kicking off its latest multi-billion-dollar Australian debt sale as well.
Lizzie, first of all, I like the misery going around the world idea. I think that's perfectly put. And I think it's actually a triple storm, or a perfect storm, if you will. One is the AI hyperscalers raising debt, including Alphabet coming to Australia. I mean, they've raised about $1.5 trillion worth of debt this year alone. That is the most since the pandemic. So I think that is weighing on sentiment. That is providing the immediate catalyst for the yields higher. And, you know, we are just at the start of the AI capex cycle, as you know. And I think that, you know, there's lots more to come from the hyperscalers. And therefore, this spending is going to continue for the next 4 or 5 years, and I think that will have an impact on treasury yields, because, you know, if fund managers who can migrate between treasuries and investment grade debt are going to overweight investment grade debt, and therefore the spread between investment grade yields and treasuries is going to come narrow, because treasury yields are going to climb higher. And then you've got the perfect combination of, you know, deficits that are unchecked, inflation that has been uncontained for 5 years now. So if you put all those heady things into the cocktail mix, it's a pretty potent combination. And that's why we are seeing what we are seeing in the markets.
So what's the thing then, Ven, that will put a ceiling on yields?
Well, I think that, you know, we saw, you know, the 10-year visit to 5% levels in 2023. We have come off those levels. We've never gone back, and we are still quite a bit far away from those levels. But I think that if we get to 5% on the 10-year, that will push up the 30-year as well by sheer correlations. And that will be an interesting entry point for many people who are thinking that, look, you know, these are yields that are too tempting. And that may clear the market, because that may see a short-term equilibrium there. So I think that, you know, we are some way off those levels, as I mentioned, but I think those levels are staring in the face of bond investors.
OK. Ven, thank you very much. That's Bloomberg MLive strategist Ven Ram. Now, let's get more on this conversation, put it all together, get some analysis. We can cross over to Jimmy Muchechetere, who is Senior Equity Analyst at Investec. Jimmy, great to have you on the show this morning. How much should we be blaming the higher yields story for the misery, as I have put it, that we are seeing in equity markets around the world this morning? And do you expect that story to continue?
Well, thanks for having me, Lizzie. I think you're right. I think what the previous guest just said is correct, that we are at the beginning of this AI capex build-out. And it is the bond market that's going to be, you know, every so often putting the brakes on the speed of this AI capex build-out. And so whenever yields blow out, we will get a slowdown. But our analysis suggests that, you know, we are still early in this AI capex build-out, and yeah, we've got loads more to go.
Well, yeah, we're waiting for Nvidia to report. That's one of the few catalysts that we shall be getting on the horizon. What does it need to come out within these numbers to keep the AI trade going?
I think Nvidia is actually de-risked simply because of the commitments that we've seen from the hyperscalers. You know, I think they combined in total, they have committed to around 2.4 trillion in AI capex, and a significant chunk of that will be going to Nvidia and the other providers of this AI capex build out. So we don't think Nvidia is likely to disappoint. Yes, expectations are high, but there's a lot of money coming Nvidia's way, and yeah, they should it should continue to do well. The only thing with NVIDIA is that everyone owns it. So any incremental performance has to come from something particularly spectacular, which, given how elevated expectations are, it's unlikely to happen. So we're expecting NVIDIA to report a very good quarter and the reaction to be muted at best.
But more broadly, how worried should US tech investors be about China? If China's offering good enough but cheaper, will that in the end be best?
I think it depends. Where there are security concerns, then the Western world will always continue to use US and Western tech. Where there aren't any security concerns, then people will pivot to the cheaper alternative for sure. We don't think that is a big issue, but we think this is a generational bifurcation in terms of investment, such that we have to have these hyperscalers putting in so much money. In fact, I mentioned the 2.4 trillion. That's on balance sheet. Off balance sheet is even bigger in terms of commitments and lease agreements. So, there is a lot of money being put to work here, and part of it is to remain ahead of China, but part of it is, this sovereign AI capex, so that, each country will have its own AI that is geared towards its own people, its own economy, etc., and particularly important for security reasons.
So, Jimmy, away from the debt story, and of course they're linked, but if we can turn to the geopolitics, we've had President Trump saying that he's in no rush to end the Iran war, Brent back above $90 a barrel. How much geopolitical risk should be in equity prices right now?
Yeah, it's interesting that the geopolitical risk in equities has been fading since the war broke out. Some economies are more at risk, the UK being one example. Whatever happens in the Strait of Hormuz has a much bigger impact on the UK economy and UK interest rates than it does in the US, for example. And that goes for the rest of Europe. So it depends on which economy we're talking about. But certainly oil that is sustained above 90, even above 100 becomes a problem. What we have seen, though, is investments to reroute oil outside the Strait of Hormuz and to have new sources of oil being produced, particularly in the US, for example. So, we are finding that ingenuity is making economies kind of solve this problem, as it were. And this is not going to be a problem going forward. We think that the big story remains AI capex and AI productivity. So right now, AI capex continues to be the big story, but AI productivity should start to take a hold as companies use more and more AI products and, start to reap the benefits of that spending.
OK, so hope on the horizon from AI. You mentioned the UK. Let's just zoom in to the UK economy, because, of course, we had the jobs data out earlier this morning, painting a picture of a weak labour market. But the CPI numbers tomorrow are expected to show inflation accelerating. We had a vote split at the last meeting with 3 dissenters. How hawkish or cautious do you think the bank's going to be in the future?
It's difficult to say. I think we will continue to have a split decision for sure. And, the data are actually conflicting. The job growth was surprisingly good. I think what will be the determinant is the oil price for sure. So we will continue to see, a keen eye being put on that oil price and whatever happens in the Strait of Hormuz. That's one. But the other thing is going to be the new administration and the Benham's administration, what they're going to do. So far, they have decided to go for small, low-hanging fruit wins that do not destabilize the bond markets. And if they continue to do that, then that's going to be important. So I think in the meantime, we're not going to see that much movement. What will be important on the horizon is going to be the first budget from the new chancellor and what direction they set in terms of the UK fiscal picture. So that will be the main determinant in the future. But in the short term, it continues to be oil and inflation, or oil and the impact on inflation in the UK.
Well, yeah, let's see how many leaks actually seep out of the Treasury in advance of that October 28th budget. Jimmy, thank you for your analysis on the programme this morning. Really great to hear from you. That's Jimmy Muchechetere, Senior Equity Analyst at Investec. Well, coming up on the Pulse, BHP's reported a jump in profit thanks to higher copper and iron ore prices. So we're going to get you the new CEO's first interview since taking on the role. That conversation coming up next. This is Bloomberg. This is The Pulse. I'm Lizzie Burden in London. Now, BP shares are in the green this morning after the company reported full-year profit up by almost a third. Improved copper and iron ore prices helped the world's biggest mining company to beat forecasts. Speaking with Bloomberg in his first interview as CEO, Brandon Craig touched on the company's portfolio as well as the volatility in the Middle East.
For large porphyry deposits, which Escondida is one, and that's dominant in Chile, grade decline is entirely normal. You have to continue to invest year on year into these assets to continue to grow the volumes. So when you have a look at the plans we have underway currently at Escondida, we're going to be building a new concentrator. That new concentrator will allow us to more than offset the grade decline to be able to produce the copper that the world is going to need. And that's important because Escondida is the world's largest copper mine. The world in some respects depends on the success of that business, so it's important that we make those investments successful. But in addition to Escondida, we also have very attractive projects in Argentina, with a project called Vicuña, which is a joint venture with Lundin Mining. And we also have very attractive growth options right here in Australia through Olympic Dam. So you put all of that together, and we're going to be able to put together a growth program over the next 5 years that will lift our production in copper by 50%. And when you consider that we are already the world's largest copper producer, adding 50% to our production base over 5 years, that's pretty attractive.
You've already said that the bar for copper M&A is going to be high. Are you restless for more assets, or are you too focused on sort of execution versus more ambition?
Well, when you look at the quality of the organic pipeline we have in BHP, the copper intensity of our investments ranges between $16,000 a tonne and $30,000 a tonne. If you had to go and try and buy a pure play miner on the market today, together with a takeover premium, you'd have to pay $85,000 a tonne plus a takeover premium, so call it well over $100,000 a tonne. Relative building our own copper for $20,000 or thereabouts. So you're talking a factor of 5 to 1, which I think really showcases why the organic pathway we are choosing is so attractive to us.
It's a challenging broader environment to be doing business, particularly when you're so heavily reliant on global supply chains, right? What's been the impact of the Middle East crisis?
It's something we've watched very closely, of course, because the Middle East supplies crude products that go into refineries in Southeast Asia, which translates into diesel for companies like BHP. What we've learned is that the supply chain risks in terms of experiencing physical disruptions have actually been lower than what we expected. But how we have seen it play out is more in the pricing space. So input costs for critical commodity inputs have gone up. So diesel has gone up, the cost of ammonium nitrate has gone up, the cost of acid has gone up. So we've had to work very hard to offset those cost increases because of what's happening in the Middle East. But at this stage, we haven't seen any disruption risk to our business.
That was the BHP CEO Brandon Craig speaking to Bloomberg's Heidi Stroud-Watts. And we can get analysis now with Martin Ritchie, Bloomberg's metals and mining reporter. Martin, you were listening to that conversation. This is a business that's doubling down on copper. How can it be thriving then when, as we discussed at length yesterday, China's economic picture is pretty dour?
Yeah, I suppose that speaks to sort of the changing dynamics in the metals and the commodities markets now, where, you know, for the last, say, 20 years, up until a few years ago, China's been the big driver of copper demand, of steel demand, of everything else. It's been the thing that really drove markets and drove the priorities of miners. But if you look at something like copper, the reason why miners like BHP talk about it so much, and you've seen that in the results today, is because, you know, demand is growing across the world now. Demand from renewable energy infrastructure, from power grids, and a lot of enthusiasm for potential demand from artificial intelligence as well. So those are kind of like very big, broad themes. And if you look at the iron ore business in BHP, which is still heavily reliant on China, that's not quite so performing quite so well. It's still chugging along, still quite nicely for them and for Rio Tinto. But it's really copper that's the priority. And you've seen that today with the relatively new CEO, Brandon Craig, talking about expanding their plans for copper growth, big plans over the next decade to raise output in Australia, in Latin America, and other locations. And you've seen it in the past week or so, all this enthusiasm for copper, with prices going up very sharply, almost to record highs this week. And that makes it kind of good timing for BHP to, you know, extol the virtues of their expansion in copper.
OK, Martin, really appreciate your insights there. That's Bloomberg's Martin Ritchie. Well, we are looking at BHP shares gaining slightly, now 0.2% here in London. Of course, we've already seen the Australian market reaction which was a little more enthusiastic. And as we look to the commodities space, copper is actually a touch weaker, I believe, this morning. But we are seeing quite sizable moves across the commodities space, including a higher oil price this morning. Well, next up on the programme, we're going to turn to Spain's migration crisis. Its migration minister visiting Ceuta following criticism of the country's response to that crisis. Well, we'll discuss all of that next. And this is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Oil continues to climb as President Trump says he's not interested in extending the expired truce with Iran. Global bonds, meanwhile, extend their declines on concerns over US government spending and a flood of long-term debt. Plus, Bloomberg learns that Anthropic is on track for a sevenfold surge in revenue as it prepares for a blockbuster IPO. Well, sticking with that story, Bloomberg has learned that Anthropic is on track to generate annualized revenue of more than $65 billion based on its current performance. We can get more now with our Bloomberg senior strategist, Neil Campling. So, Neil, it seems to me like Anthropic is beating OpenAI right now. What's it doing that OpenAI is not?
Yes, Lizzie, so I think what they're doing very well is monetising the AI opportunity. So, in effect, Anthropic is, if you like, the corporate version of AI, whereas OpenAI is really the free version for us as consumers to use.
Hence why it's well known.
Hence why everyone seems to know that product. But really what Anthropic is doing is making tasks and day-to-day business so much easier to do and are able to charge, obviously, for that. The kind of revenues we're talking about here, it took Google 16 years to get to this revenue run rate of $65 billion. And in fact, you know, Anthropic's only been around for 4 years. After 4 years, Google was reporting $1.5 billion of revenue. Different era, of course, but much smaller in terms of the numbers. So it just shows the kind of scale that Anthropic has got to very quickly. Well,
speaking of OpenAI, you've got a new deal between NVIDIA and OpenAI. Is that worrying in the sense that there's more circular funding coming around? And what was that money going to be for?
I think it helps, again, fund the data centres and the infrastructure that's being spent. And of course, OpenAI, by not monetising the AI so well, needs to look for funding from elsewhere. But this will raise those questions around circularity again, and whether the bank of NVIDIA is really funding their own ecosystem. So it's going to be a key focus in terms of NVIDIA numbers when they come out next week, I think, as well.
We've also got Baidu numbers coming out, China's Google. Where does it stand in the AI race? Because it seems as well to be behind, right?
They seem well behind even their own local other Chinese models of the competition. And again, if we look at the financials, they're really struggling to grow. It's basically growing at 0%. Compared to Google, as you mentioned them, Google are 20 times bigger in terms of size of revenues and are growing at 27%. So Baidu really needs to show some kind of proof that they're catching up in AI, but it's definitely not coming through in results.
All right. The size and scope always helps, Neil. Thank you. Always ready with the stats. Bloomberg's Neil Campling there. Now, to some other top stories that we're following for you in the tech space this morning. Meta is due in court to face a jury trial over claims that it deliberately designed Facebook and Instagram to encourage compulsive use among young people. Attorneys general from 29 US states are seeking financial penalties and changes to how Meta operates its platforms. Meta says potential penalties could reach $1.4 trillion, a figure close to the company's entire market valuation. Meta denies the state's allegations and accuses them of seeking an outlandish payout. And here in the UK, a new survey has found that most British businesses are moving beyond experimentation with AI and are starting to reshape hiring around the technology. The Lloyd's Business Barometer found that a quarter of UK employers are increasingly hiring candidates with AI skills, while a fifth are creating new AI-specific roles. More broadly, 54% said that the technology has led to job creation. So that's a pretty positive story. But if we turn to this morning's UK jobs data, employers shed more workers in July and job vacancies hit a fresh 5-year low. Demand for staff remained tepid in the face of heightened uncertainty from the events both at home and abroad. And we can get analysis now with our Bloomberg economy reporter, Tom Rees. Tom, good morning. We've had numbers on employees on company payrolls in July falling by 13,000, the number of vacancies dropping to the lowest since 2021. Why is the UK labour market so weak? And should we maybe take this data with a pinch of salt, given the volatility around it?
Yeah, so there's a couple of different elements coming together here. First of all, just our growth has been pretty weak in the last couple of years. And then the second element is what the Labour government has done since it came into power in 2024. So we had a hike in payroll taxes and quite a large increase in the minimum wage as well, which has also pushed up wages higher up the income scale. So it's basically the cost of employing a worker is much higher than it was a couple of years ago. And then, as you just mentioned, then we've got this uncertainty factor, which is kind of stopping people from hiring as much. Both Iran and also we've got a new prime minister. So businesses are still trying to work out what his economic policy is. But yeah, I mean, as you said, these figures always need to come with a pinch of salt because the UK's labour market data has been pretty poor in the last couple of years, and it does get revised very heavily. So it looks not great at the moment, but let's see how it looks in a couple of months.
Well, as you mentioned, the political uncertainty feeds into this backdrop. If this is the backdrop for the October 28th budget, how's it looking? What sort of policies are we expecting? How is it going to shape the Chancellor's first budget?
So I think what it tells us is that although we've had pretty good growth numbers in the first half of the year, the UK was the best performer in the G7. I think the underlying picture is still pretty tepid. I mean, the Bank of England thinks underlying growth in the third quarter was zero, for instance. So for the Chancellor, the challenge is still, how do you get growth, going? How do you build a budget that helps do that? And that's basically been the challenge for the last 5 years, for every Chancellor of the last 5 years. Each has tried, each has kind of failed, to be honest. So it's definitely easier said than done.
Yeah, feels like 'twas ever thus, and the UK forever fiscally squeezed, but that's a problem around the world, right? Tom, thank you very much. We'll look forward to your coverage in the run-up to that budget later in the year. Bloomberg economy reporter Tom Rees. Well, turning now to the migration crisis as we continue to talk about the movement of people, the labour market. Spain's migration minister continuing a visit to Ceuta, where she's meeting the Red Cross and social organisations who specifically look after migrants. Now, it comes after thousands of people surged across the border from Morocco in July, and grassroots calls for a second mass incursion over the weekend fell flat. We can get more now with Başak Yavçan, Head of Research at the Migration Policy Group. Başak, we're showing pictures on screen of really desperate scenes. I wonder what you've made of Spanish Prime Minister Pedro Sanchez's handling of the crisis.
Well, this was an important test for not just the Spanish policy makers, but also the EU policy makers. And I think the Ceuta crisis exposes two fundamental vulnerabilities in the way the EU has been managing migration. The first is the paradox of externalization. And that is, for years, the EU has increasingly relied on countries such as Morocco, Tunisia, Libya, Belarus, Turkey to prevent irregular migration from reaching European territory. Essentially, there's nothing wrong with a policy of cooperating with the transit countries, but relying solely on transit countries for this border management is a challenge. And here we see that it's very important. That gives a very inadvertent leverage to these transit countries, bordering countries to the EU. And in this case, we're seeing Morocco having this leverage. And luckily, this time around, the Spanish Prime Minister managed to actually a good cooperation with Morocco and a good intervention with a close cooperation with Morocco. So the lesson from Ceuta, in other words, should not be abundant external cooperation, but first to make Europe less dependent on it. And second is to build it more holistically, not just, we're paying you for border security and you're providing that, because that alone clearly is not enough. And we're seeing a lot of instrumentalization of migration if that alone is the policy. It needs to be supporting building close partnerships, supporting legal mobility through frameworks like Migration Partnership Facility, labor migration, education, skills partnership, development and protection. So it should go hand in hand with legal pathways, not just border security.
Well, when you look at individual other EU member states, was it overkill for Italy to impose border checks with Spain in response to the influx of migrants? Does it strike you as propaganda rather than national security necessity?
It absolutely was an overkill. And more importantly, it also created really many people doubting the European solidarity, because there is there's the EU Pact on Migration and Asylum, and this we're all discussing how it will be implemented. And the first real life test of it with a crisis turns into outcries for closing up Schengen, which essentially does not have much to do with it. Yes, so it was very domestic politics oriented. But policymakers in the member states, such as in Italy, need to think about this, because this kind of instrumentalization of migration may have the intention of creating instability, destabilizing Europe. And it's exactly doing that when a leader goes around denouncing Schengen or, putting the solidarity mechanism out of the window.
But let me put the counter-argument. How real is the risk to the integrity of Europe's borders? What other vulnerabilities do you see to the European perimeter in the near-term future?
Look, I don't think border security is something to be taken lightly. It is very important to create secure borders and fight with smugglers. But I think that the border migration management is not only about border security, which seems to be the perception. And if we reduce migration management to border security, we're essentially going to fail at it, because we're giving in the hands of all the neighboring countries, all the transit countries, the leverage of instrumentalizing migration. And that makes the EU more vulnerable at the end of the day. So we need to have an approach that is both combining legal pathways, combining good border management, combining good integration policies. Those are all very different things. But unfortunately, the political climate in many member states creates this scapegoating approach that behind every problem is migration and border security, and the way to get back at borders, those who are infringing the borders, is to make integration more difficult for those who have been living in a country for 5 years and paying taxes. So I think there are really very different things, and there is a very big tendency to convolute them at the risk of social cohesion.
What about the role of social media companies? Are they doing enough to clamp down on misinformation that's fueling this in part?
Yeah, that really is a big challenge. And honestly, there is a lot of research that focuses on this. And unfortunately, the problem is once that information, a misinformation, a disinformation, and incorrect information gets out, even if you correct it, it doesn't reach the audience anymore. So it reaches a very small percentage of the audience. So there is so much benefit in managing public opinion through these disinformation campaigns. But I think it's also important for the public to be aware that there is this tendency of creating these propaganda, and we need to be careful about the news that we're exposed to, and we need to think twice before spreading it, before sharing it with our friends, or before actually, as in this case, acting on it and trying to migrate.
So, Başak, this is your area of expertise. I feel like, this isn't the first time that we've seen scenes like this on the TV. Historically, does this crisis mark a turning point when it comes to progressive migration policy across Europe more broadly?
Well, I don't think this is the first time. And we've seen in 2020, Turkey opening the borders, and then Belarus, and then we had a case with Morocco. So what essentially the externalization policy of the EU does is, by giving third countries the authority, the power, the competencies to control the borders, in return for some financial benefits, the ability to actually control them, and when there's a conflict between the EU and these countries, any EU member state and these countries, as in the case of Spain and Morocco previously, not at this time, then you have this third country is capable of just opening the borders and instrumentalizing, you may also call it weaponizing, migration. We've been saying that this is the very direct outcome of externalization policies. We have actually collected a very large data set of bilateral agreements between EU member states and these third countries on migration. And we see how narrow these agreements are, that they only focus on migration. So these are the instruments of externalization. So this brings me to the initial argument that I have made, that these agreements should be more holistic, more overarching, so that they create a deeper cooperation with these third countries. They take their preferences into consideration, their needs into consideration, rather than just for quick quid pro, you stop my border crossings and we give you money for it.
OK, it's really helpful to think about how to frame that policy going forward. Başak, appreciate your insights this morning. That's Başak Yavçan, Head of Research at the Migration Policy Group. Thank you very much. Well, coming up on The Pulse, it's known to its friends as Harney Nicks. Now the posh British department store has been snapped up by none other than the retail billionaire Mike Ashley. We'll look at his burgeoning property empire next. This is Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything. Earnings season is here.
I think it is a significant moment. Record quarterly profits.
Bloomberg is first to break the numbers.
Stock traders blow past estimates at France's biggest bank.
With the smartest insights.
Do you think the age of the mega deals in pharma is back?
Growth has been more than 60%.
The investment bank, as you say, has done extremely well.
We're just getting some slight signs that maybe consumers are adjusting their behavior.
Continuing coverage on Bloomberg. Context changes everything.
This is The Pulse. I'm Lizzie Burden in London. Now, Vitol, the world's largest oil trading house, has turned the Hormuz crisis to its advantage in a little-watched corner of the global commodity markets. That's the story covered in detail today on The Terminal and today's Big Take. Bloomberg's Jack Farkey joins us now for more. So, Jack, welcome to the programme. Your investigation finding that some African countries have been paying very, very high prices for oil from Vitol, but the contracts are largely awarded outside the normal tender procedures. So tell us, how did Vitol achieve that?
Yeah, I think the key context here is the war in Iran and what's been happening in the oil market, and also particularly in the market for refined products, things like diesel and gasoline, which is what we all actually use rather than crude oil, and in particular countries in East and Southern Africa, particularly the east coast of Africa, are historically very dependent on, first of all, imports of refined products. There aren't any refineries in the region. And secondly, imports from the Persian Gulf. And so when the war in Iran began, and when the Strait of Hormuz effectively closed for a period of time, that left those countries pretty exposed. And the trend that we saw and that we've written about in this story is for a number of countries to go and strike deals, often exclusive supply deals, often deals that involved putting aside their normal transparent and competitive tender systems or other purchasing systems to strike deals that ended up making the countries exclusively supplied by Vitol.
So that explains kind of why African countries would sign these contracts, but why haven't other companies done as well then?
I think there's a couple of things going on here. One is obviously that some of the companies that traditionally supply the region were state oil companies from the Middle East, which had a number of problems as a result of the war in Iran. The Strait of Hormuz was closed for a period of time. They couldn't get their oil or their oil products out of the region. Also, some refineries were hit by drones and missiles. So that's one part of the story. I mean, I think when we look at these prices, and we've written, and it's quite a detailed story, and I'm afraid that going into the details of how commodity supply contracts are priced, by necessity, you have to go into the nitty-gritty detail, and I'd encourage people to read it and have a look at it. But when you talk about the price of a particular contract, it's very hard to say definitively and absolutely that price is the wrong price. There were a whole load of circumstances that led the contracts to be done at the prices that they were done. But organizations like the IMF have pushed for these kinds of purchasing deals to be done in open, transparent and competitive tenders for exactly the reason that then you can see what all of the offers in the market are. And in these cases, we haven't had that. And so that makes it harder to say they definitely were the right price.
I definitely recommend a read of this. I read it with my morning coffee. It's a fascinating read. Just talk us through the response from Vitol then.
Yeah, so Vitol says, a bit much like the African governments that we're writing about, say that they were able to step in and supply the region and to secure these contracts because they were able to offer supply security at a time when lots of other companies weren't, and when there was a lot of uncertainty about supplies and a big disruption in the market. They say that their prices were competitive and that in some instances their contracts involved elements beyond headline prices like favourable financing terms for African buyers that made them attractive.
All right. As I say, recommend a read. The big take today from Bloomberg's Jack Farkey. Thank you so much, Jack. Now, AbFab fans, pay attention. Posh British department store Harney Nicks has been snapped up out of insolvency by Frasers Group. Retail billionaire Mike Ashley adding a historic brand and a prime flagship store in Knightsbridge to his growing property empire. Bloomberg's consumer reporter Maddie Parker's with me now with more on this story. And Maddie, how does Harney Nicks fit within Fraser Group's wider retail and property portfolio? Because it seems to me it doesn't. I'm thinking about Princess Di and the AbFab ladies.
Yes, totally. I mean, Harney Nicks is such a kind of storied department store brand. It really conjures up these images of its heyday in the 90s. As you say, kind of classic shopping hall for Princess Diana, and had a lot of popularity in TV shows like AbFab as well. It's very interesting, of course, that it's come into Frasers' portfolio. This is a group many people will know kind of better at Sports Direct, which is where it made its fortune, selling cheap sportswear. So it's kind of interesting that it's gone from this move and now has this very storied department store chain with the Knightsbridge store and its regional stores as well. It's interesting. It's basically part of this wider Frasers push into the luxury kind of high-end market. It's the second largest shareholder in Mulberry. It's taken a stake in Burberry. There's news this morning about Hugo Boss as well. So it's a big kind of push into luxury, and this is kind of where this comes into the portfolio as well.
Well, I don't want to do down Mike Ashley. Where does Frasers Group's ambitions lie from here then?
Yeah, it's really interesting. I spoke yesterday with their CEO, Michael Murray.
Very good.
He was chatting a lot about their portfolio. It's currently valued at about £2 billion in terms of the property side. He tells me that will be $20 billion within the next decade, so increasing tenfold. We'll see if that happens. But I think, interestingly, just on the Harney Nicks front, what they'll do with that, I mean, there's some inclinations that they'll keep the Knightsbridge store and the Edinburgh store kind of running under that Harvey Nichols brand. They may well convert some of the regional stores to Flannels, which is one of their main luxury brands. But that seems to be their push going forward. But he did mention they might as well diversify their portfolio a bit, investing in residential real estate, investing in office real estate as well.
And there was I hoping for Sports Direct prices over at Harney Nicks. Look, Frasers Group's increased its stake in Hugo Boss as well. Where does that brand fit into the strategy?
Yeah, it's interesting. So Hugo Boss, this is just news this morning. They made a cash bid, 38 euros a share, and Hugo Boss really urged its investors to reject that, and they did. They increased their stake, as you say, to 48%, so falling just short of that 50% mark. It's interesting. They'll have to see where they can go forward with Hugo Boss. As I say, they've got that eye on a lot of those luxury names. Hugo Boss is one of those that has struggled over the past few years, and as we know, Frasers, the one thing they always want, they have their eye on a bargain and an eye on a deal, so they'll probably push forward with that.
All right, great reporting. Bloomberg's Maddie Parker there. Well, coming up later, the former US National Security Advisor Jake Sullivan will be joining Balance and Power at 6 p.m. London time. But that does it for The Pulse. We pass the baton to New York for Bloomberg Brief. Stay with us. This is Bloomberg.